Our guest today is David Zaring. David is a legal scholar and professor at the University of Pennsylvania, where he works on, among other things, legal issues facing the Federal Reserve System. Today, he joins us to discuss two big legal issues facing the Federal Reserve. First, the issue of the Fed's skinny Fed master accounts and challenges to them, as well as challenges to who governs and how is the Fed accountable to Congress and other entities. David has written widely on both of these topics, and he joins us today to help shed light on them. David, welcome to the program.
It's a pleasure to be here, David.
It's great to have you on. Now, we recently crossed paths at a conference you helped organize at the University of Pennsylvania, the Wharton Financial Regulation Conference. And it was a real treat for me, a macro guy, to be invited to hang out with the cool financial regulation scholars like yourself, Peter Conti Brown, and others. And Peter and I did a podcast there to kick the conference off. So it was really fascinating because what I learned from Peter in that podcast is that pre-2008, a conference like that simply would not have existed. You guys, the group of you, and I think of a number of podcast guests and friends I now have made, you, Peter Conti Brown, Dan Ari, Kate Judge, Lev Menon, Jeremy Kress, Graham Still, all these people do financial regulatory like scholarship. Some are former policymakers, but they're all a product of the great financial crisis. So tell us about that and how your story kind of fits that narrative.
Yes, I think that's exactly right. The financial crisis sort of created a need that the legal scholarly community didn't know it had for financial regulation scholars. And before the financial crisis, there weren't many financial regulation scholars. They often taught at pretty fancy law schools, but they sort of viewed banking regulation as something that was sort of like corporate law and raising money through securities issuances. And they were sort of clearly on the business law side of the spectrum. So sort of private law only with a regulatory overlay, and banks was about bank mergers and unit banking and then lending requirements and stuff like that. And after the financial crisis, we saw that in a crisis there's a lot of public interventions that happen in financial regulation that really mean that it can be pretty well looked at as a species of just regulation more generally. So I came into the academy as sort of an administrative law scholar, but I'd done some research on for a law professor in law school. I was her research assistant, and she was interested in the way that regulators collaborate with their foreign counterparts. And so I'd studied the way that financial regulators collaborate with their foreign counterparts, and they do so in a pretty elaborate way. But after that, I hadn't thought too much about banking until the financial crisis. And then I came back and thought to myself, well, this is really an important subject and a subject that is really tractable by thinking about it as a form of regulation, just like other kinds of administrative law. And a lot of my research has been sort of making that case or making the opposite of that case. Maybe we'll talk about the opposite of that case later, the ways in which the Federal Reserve and other banking regulators don't really conform to typical notions of administrative law. And I've also got a bunch of papers on the SEC and how it is and is not a typical administrative agency. So that's the value I try to bring to the scholarly debate about what banking regulation is and how it works and why it's important. And the reason why so many of the people at that conference think it's important is because they lived through the big financial crisis, which drove home for us just how critical all this stuff was.
Yeah, it's amazing the legacy of that experience, right? The Great Recession or Great Financial Crisis, everything from how we think about monetary policy, fiscal policy, to the scholarship we do, legal field, economic field. I mean, the impact will go on for probably as long as there is this profession. So it's great to be a part of that. And it was great to run into you there as well as others. We learned about a number of other people who love the podcast, including you and Peter and folks there. So that was a great event. So I encourage listeners to go out and check out that conference if you can. And the podcast too will have been out before this one does. So some of the folks will have heard that conversation. Now, as you mentioned, you're writing in this area and you have several great articles I want to talk to you about. And the first one I want to talk to you about is a recent article of yours that deals with the question of skinny fed master accounts. So you had it in the Journal of Corporate Law, and the title was Skinny Charters Rebuilding Banking Regulatory Perimeters. Now, here's the cool thing about that paper, other than it's an important topic, is you came up with the word skinny before Governor Chris Waller, right? So you were hit before it was before others were using that term.
I feel like an influencer at this point,
There you go. Yeah.
So
Yeah. So you had that article published prior to the use of Governor Waller's term of skinny fed master account. You called it skinny charters, but that skinny part was there. And so we're in the midst of this. There's a lot happening here in this space. We just, in fact, recently learned that Kraken, who applied for a regular, I guess, master account all the way back in 2020, finally gets one. It's like a trial run. I guess it's like a sandbox. So let them go play and see how it works, work out some of the kinks. I know they recently took comments on the proposal. But let's step back, because I know you've been a part of this story for some time, even before this article came out. Weren't you a part of the litigation? Were you like an expert witness in some of the cases we're going to talk about?
yes, I participated in litigation over the OCC's Fintech charter, which got up to the Second Circuit in, I think, 2019. And I've also weighed in on Custodia, the Wyoming crypto brokerage. They sued. They asked for access to the payment rails, the Fed's payment rails. A while ago, and the Fed sort of arguably slow walked it, and ultimately denied their request. And then they sued in Wyoming and in the Tenth Circuit, arguing that they were entitled to a master account as a matter of right. And I participated in that litigation just as an amicus. I weighed in on the side of the Kansas City Fed on that, and in that sense, it was a sort of interdepartment dispute in some ways, because my colleague Peter Conti Brown, Peter, who you've done the podcast with, he weighed in on behalf of Custodia's case, arguing that they were entitled to a master account as of right. So we're still good friends, but one department in Wharton speaking on both sides of this question of whether Custodia was entitled to a master account access or not.
Let no one say that there isn't representation from both sides at Wharton, right?
Mm.
We have, people speaking from both perspectives. So yeah, but Custodia is probably the most interesting and probably best known case. Attracted a lot of attention. And just to go back and highlight this, this is a Wyoming specially purposed depository institution. So it's a state chartered institution, a fintech company, and they asked for account back in 2020, the same time as Kraken. I guess the irony coming back to the Kraken point, Kraken, they got one, and they've been kind of silent. I mean, it's a long time, like 5, almost 6 years here. And
Really
Custodia's, yeah, really slow, but Custodia has been kind of the one that keeps making all the noise, going to court. And Kraken's just been kind of quietly under the radar, and boom, it got it. So this can't be, something that Custodia was excited to see happen. But nonetheless, it has happened. And again, just to go back and trace some of these steps out. So you mentioned this already, but they apply in 2020, and they're a fintech company. They have a special state charter, and it takes forever for the Kansas City Fed to actually recognize. So eventually, as you mentioned, they go to court to get it disclosed. And I believe the district court said no, the 10th Circuit said no. And then they did some kind of appeal, some process. So the 10th Circuit said no again. So the next step would be the Supreme Court. Is that right, if they really wanted to push this?
That's right. They tried to take the adverse decision of the 10th Circuit en banc, which is what lawyers say when they mean every judge on the 10th Circuit, rather than just 3 of them.
Okay, that's what it means.
Would consider Custodia's appeal. And this is inside baseball, but the 10th Circuit rarely ever goes on by. So that was a tough ask, and indeed they decided not to do so. So it's the Supreme Court or bust for Custodia. Though they may. They may be able to ask themselves, well, will we be eligible for a master account if Kraken eventually got one under the new Fed regime? Maybe they can apply as a Tier 3 institution and like Kraken which received, they're pretty similar businesses, both crypto facing Wyoming special purpose depository institutions. And so, Custodia may think, let's not spend all that money on a Supreme Court, Hail Mary. Let's see if we can't go the Kraken route and get access to a master account under the new thinking at the Fed.
Yeah, it seems like that'd be the straightest path ahead, right? It's just take this new regime that's being implemented. And of course, there's going to be challenges to this. I know, like the Bank Policy Institute's not thrilled about these master accounts,
Yep.
skinny Fed master accounts. We'll come to that in a minute. But one last question on the legal side, since you're a legal scholar. I heard some people make a big deal about the fact that it was 7-3 on the 10th Circuit. Like, there's three, who were supported. That sends a loud signal if you were to pursue. Now, maybe they won't because it'd be cheaper just to go straight the path you outlined. But if they were to appeal it, does 7-3 matter? Like I've heard some people say.
It's not nothing. One of the things that the Supreme Court is looking for is a circuit split. That's the easiest way to get there, to say, look, they're doing it differently in the 10th Circuit than they are in the Ninth Circuit than they are in the Second Circuit.
Okay.
And that's your fastest route to certiorari. And so far, the Fed's got a pretty good record of litigating and winning these master accounts cases. And so Custodia doesn't really have a circuit split it can point to. It can say that, and this is one of the reasons why you get these sometimes dissents or dissentals, they're sometimes called, in en banc things, and that it puts the Supreme Court on notice that, look, there's a lot of judges in the lower courts that looked at this and think that there's a problem here. And so sometimes for important cases, the Supreme Court won't wait for that split to develop, but will say, look, this is an important case. We think the lower court got it wrong. We think so because the dissental, the three judges who would hear it en banc are pretty persuasive. Judge Timkovich, a well-respected judge, dissented the three-panel decision. He thought that they should get access to a master account. And so all of that is stuff that is marginally helpful when it comes to getting the Supreme Court to hear a case, but isn't the sort of gold standard of the Ninth Circuit's doing this differently. We need to create a uniform national standard.
Okay, well, we'll wait and see what Custodia does. It'll be interesting to follow. So This has been a long journey for them. And I guess the irony is, it was the Kansas City Federal Reserve Bank that denied them, but then said yes to Kraken. So that, I don't know, that's like rubbing salt in the wound. It seems like, at least from this perspective.
I can imagine Custodia's executives must be thinking, what on earth,
Yeah, right.
This is something that actually has a rich and not that healthy tradition in financial regulation. Is there's always this concern that, like, if you come after your supervisors, you try to vindicate your day in court, that they'll take it out on you next time, that it's not worth the candle, because they can enact reprisals on you. And it's not obvious that financial regulators could do that to a fintech like Custodia, but now they're sitting there without one of these master accounts and seeing one of their competitors get one. They must be pretty worried about that, I would imagine, or asking themselves, wait a second, is this because we sued, or is this, what's going on here?
It could be that, or it could also be to be charitable to the Kansas City Fed. Maybe they got a new president and they're like, look, it's been a minefield. Let's just start with a clean slate. Let's say yes to this one firm that has applied, that has waited patiently, and let's see what happens. I mean, maybe the Kansas City Fed is the sandbox for the rest of the Federal Reserve System. Other banks are looking on. Okay, let's see what you guys do. So it'll be fun to watch. But David, as you know, the plot thickens, and just to flesh this story out, because this sounds like a boring story on the surface, but actually it's full of drama. We've already touched on some of it, but what made this interesting, I think really interesting, is the story of Reserve Trust Bank, which I believe in 2018 got a Fed master account, and at least the allegations were that a former Fed governor had joined the board and then got it, the application to pass the finish line. And then Senator Pat Toomey, who's been on the podcast, he noticed this, as well as Custodia. I think Custodia made a big deal about this as well. And so he pushed hard when this person, Sarah Bloom Raskin, she was going to be a governor, I believe, under the Biden administration. He pushed her really hard on this. Or at some point, he pushed her hard on this. And so this led to a lot of commotion. And I guess one thing that came out of it that was a win for everybody was the Fed had to disclose. He got it passed into law, but I think all this commotion built the momentum to get into a spending bill. The Fed has to disclose a database of all the people who've applied or have a Fed Master account.
That's right. Transparency is always welcome. And now there is some transparency, at least with regard to who has this and who doesn't. Uh, so that is something. Yes, when I think about what led to all this, I think really what we're talking about here is the rise of the fintech industry, financial technology firms, which kind of want to offer banking-like services, but do so without necessarily all the rigor of bank regulations. In some ways, that's a reasonable goal if the fintechs end up, holding customer money and taking care of it in a way similar to the way that a bank might. So, if a fintech is sort of a customer acquisition service for a bank that will work with the fintech or partner with the fintech, then I think depositors and financial stability types don't have much to worry about. But if fintechs are a whole separate business that basically offer banking services without complying with safety and soundness banking regulations, then, you could imagine that introduces a lot of risk to the system, a lot of risks that consumers who patronize these fintechs might not be aware of. And so that's the debate. What are fintechs and how should we regulate them? And so the rise of the fintechs led Obama's comptroller of the currency, Tom Curry, to come up with this idea for a fintech charter, which would be a way that fintechs could be regulated by OCC and get the benefits of nationwide regulation and maybe preemption of state consumer protection laws and the requirements of state money transmitter licenses. The Trump administration's, their first comptroller of the currency, seemed to be totally fine with this, but no fintech has applied for a fintech charter. They've been scared about the legality of the program and maybe the expense. And so, a bunch of states sued OCC over the fintech charter. That's the first litigation that I participated in federal appellate court in New York, the Second Circuit. The Second Circuit decided, wait, we don't need to decide whether the OCC has the power to charter fintechs or doesn't. Let's wait until we have an actual charter application that's being granted, and then we'll decide, does the OCC have the power to do this or not? So they tossed that litigation aside, and that's where the fintech charter stands. The Biden OCC didn't seem interested in approving a fintech charter from that office. And so we still have this program that's been in existence since 2014 that no one has applied to take up. Instead, fintechs are often turning to trust charters. And then now with Kraken and with the skinny charter proposal of Governor Waller, they're maybe going to wait and see if they can get access to the Fed's payment rails. And maybe that'll be enough for them, that they won't need some full sort of federal charter, but rather sort of payments access that makes transacting cheap and fast for them and avoids the costs of sort of partnering with a correspondent bank that already is using the Fed's payment rails.
Okay, well, that's a nice transition into your paper. So where we are currently is these fintech companies or other firms like them, they're doing two things. They're reaching for an OCC trust charter and then combining that or using that as a way to get into a skinny Fed master account, because you still have to be some kind of depository institution that's recognized under the Federal Reserve Act. So those two things are working together, although they may be challenged. And you have a paper that outlines a bold vision for what really needs to be done. Because I had Dan Ari on the show, and he goes like, yeah, they're kind of like really doing legal gymnastics to get this thing through. I mean, the OCC trust charter and the SCED master accounts, they really need something more bold, an actual change in law, which is, I believe you've also suggested too. So again, your paper is titled Skinny Charters, Rebuilding the Banking Regulatory Perimeter. So tell us about the arguments you make in there and what you would like to see be the final solution to this tension we see in the industry.
Yeah, so in that paper, I talk about something that people sometimes worry about quite a bit, and I'm a little less worried than maybe some others are about the separation of banking and commerce. And so the idea here is we don't want to let a bank sort of run a factory, and by the same token, we don't want a factory to sort of end up providing banking services to their clients. So the concern is that once you get a banking charter, you should only engage in the business of banking, which I guess is the OCC is defined as three things. You take deposits, you make loans, and you handle payments. So the old conventional wisdom is if you're doing those things, you're a bank and you need a banking charter. And if you're doing something else, then you don't need a banking charter and you can go get a Delaware corporate charter and do whatever you want to do in business. But you don't need to go to a federal banking regulator to do that. And I don't see, just to make the bottom line upfront point, I don't see why you couldn't offer a series of bespoke skinny charters, a full charter for banks, which require a lot of federal regulation. The problem with banks is, it's a wonderful life problem of the loans can be the way the banks finance themselves through deposits, can leave at any moment. And yet they're using the deposits to fund loans, which can't be recalled at any moment. Maybe for a home mortgage would last 30 years, or for a loan to a business might last multiple years. And so this is all well known to banking scholars that the lending is done long and the borrowing is done short, and that's a so-called maturity mismatch. Okay, if you want to be in the business of banking, maybe you need to have somebody looking at both your lending, your lending decisions, and somebody worrying about deposit insurance to ensure that your depositors are protected. And if they're providing you with insurance, then they're going to want to make sure you're not taking big risks. So that's the regulatory scheme. And that's why we have a pretty heavily regulated banking system where you have the FDIC and other regulators, state regulators, federal regulators, if you're looking at a national bank, coming in to make sure that these banks are safe and sound. And I think that the federal regulators could offer to split their charters as new businesses do some, but not all of the business of banking. So a firm like PayPal, not making loans, not really taking deposits, though sometimes people leave money in their PayPal accounts, but definitely trying to process payments instantaneously. They might love to have access to the Fed's payment rails, and so maybe they should be able to get a payments charter. Or you can think of a lending firm, like a peer-to-peer lender, not taking deposits, financing lending, or private credit maybe is an example of this. Financing lending by going out and raising money from investors. Maybe a lending charter would be a way to get them out of burdensome state-by-state regulation if they're lending on a nationwide basis. Or maybe a deposits charter. That sort of looks like a trust account. We might sort of have something like that. But there, the idea is a bank or maybe even a non-bank could take your money and not lend it out, just custody it. Maybe secure it against treasuries and make a little bit of interest that way. But being a lender, maybe there's some room for a deposit account. And I think arguably a trust charter is kind of like a deposit account. A trust charter is the idea that we're going to take your assets and we are fiduciarily we take on a fiduciary obligation to make sure that those assets are prudently maintained. But we're not going to lend them out and have the maturity risk mismatch risk of a bank. So that's what a charter does, and arguably that's something like a deposits charter. It says we collect money, we promise we'll give it back to you, and it just sort of sits on our balance sheet until you ask for it back. So that's the idea, is that right now we have one kind of charter and it only goes to banks, but there's all these new entrants and we like competition, we like new entrants and new business models. Maybe there's room for bespoke charters for firms that want to do some, but not all of the business of banking, and get the benefits of, a nationwide market with a nationwide regulator when they're trying to do exactly that.
So would you like to see this done through changes in the law as opposed to trying to wiggle in through existing charters and, existing law?
Yeah, my view is that the fintech charter is something within OCC's powers, that there's nothing magical about the OCC's definition, which doesn't really come clearly through the National Banking Act, that a bank must take deposits, make loans, and process payments.
Okay.
And so, in my view, Congress doesn't need to act. The OCC can act to create that
Okay.
skinny charter. And if the OCC can act to create that kind of skinny charter, then why not other kinds of charters? Or the Fed's proposal, which is not sort of a charter, but sort of master account access to the payment rails,
Yeah.
which is kind of as good as a payments charter, but it doesn't come with sort of the sort of sustained oversight that you sometimes see in federal banking regulation.
So you would be fine then with what they're doing, the direction they're going, maybe some small refinements here and there, but it use the existing laws, existing institutions, and just kind of push through.
Yeah, I should say that I'm not sure that our friends in the crypto industry and other financial technology interests would totally agree with me on that. We've got the Stablecoin Act, which I don't think we need to talk about, but the Clarity Act might, create some sort of chartering
Mm,
or licensing provision which would allow crypto firms to do business. And so maybe they think it's going to take Congress and not the regulators
yeah.
to make room for certain kinds of new firms like crypto firms. And I don't take a strong position on that, but I think that the banking regulators have a lot of authority and probably have the authority
Okay.
to divide up the charters if they really want to.
Okay, fair enough. I bring that up because Dan R. We wanted to see actual explicit legislation that would clearly define. But you're saying let's work with what we got, which that may be a very pragmatic way to do this because it is hard to pass laws in the U.S., especially ones like this.
Yeah, no, I agree. You always worry about it. I mean, boy, I've been, keeping an eye on how hard it's been to get the Clarity Act through Congress.
Yeah.
A real priority of a bunch of legislators. It may not happen. Boy, it's hard to pass legislation. But that said, it's always better if Congress endorses, a
Sure.
practice rather than
Yeah.
the regulators, especially these days with people really worried about runaway regulators. There are some advantages to congressional support for, a new sort of chartering program. But yeah, I
Yeah.
think legally, I think the Fed's on pretty solid ground, and it's
Okay.
to offer master account payments to non-traditional financial institutions. And I think the OCC could have done that fintech charter, or if it ever grants one, if it ever gets an application, I think it'll be okay if they decide to grant it.
Oh, that is so interesting. I was not aware of these fintech charters at OCC. I was aware of the trust charters because those are the popular fintechs are adopting the trust charters like they're going out of style,
Yeah.
but they're ignoring the actual fintech charter themselves.
Yeah, they don't want to go there, but they know that trust charters are legal and have been around for a century or so, and
Yeah.
that gives them some advantages when it comes to holding deposits, but it doesn't necessarily get them master account access under the Fed's framework, and so trust charters might get you part of what you want, but it's possible it won't get them everything that they want.
Yeah.
And so for what it's worth, some of these financial technology firms are out there going and buying banks, tiny little national banks which aren't doing much. LendingTree did this with the Radius Bank. Sometimes the CEO of the fintech firm will go out and buy a bank, a sleepy bank, and get a bank charter that way. And so that's the other way they kind of do it, as sort of entry
Okay.
through M&A. And some fintech firms are going that way.
Clever. Very clever. Yeah. So part of the pushback that you get from trying to pass a bill or even having these conversations is the established industry, right? Banks don't like to see this competition. I gave a presentation to some people who are involved with bank regulation, and they had a hard time processing the possibility that anything other than the established banking model was the way for payments and credit creation and all these different venues come together, as opposed to, well, why not just have a firm that does just payments, right?
Mhm.
Why can't you unbundle these things? Why do they have to be? And in their perspectives, well, it's taken hundreds of years to reach this equilibrium. In fact, one told me this is the optimal way to do things. We've learned this is the optimal way. I was like, really? So if you had that pushback as well, like, what are you even talking about this? We have a model that works.
I mean, in my view, the reason for a sort of full fat banking charter is to deal with full fat banks. Because what you're worried about is the maturity mismatch problem, the problem that
Mm,
depositors can run on the bank, um, and that in the case of the financial crisis, a housing crisis will affect a bunch of lenders in the same way all at once, and the quality of their assets will go down, and so their assets will go down in value, and that those two problems seem quite related to me. So, finance through short run deposits and lend long to borrowers. Uh, that's a risky proposition, inherently risky, and financial regulation and the federal, perfectedness of the. No, it's not just federal, but I guess the perfectness of the banking charter.
yeah.
It's a little tongue in cheek, but it's they do a great job. It's about dealing with the risks posed by that thing. But processing payments safely doesn't require that sort of careful attention to, loan quality and, deposit runnability. And so I don't quite understand why a payments charter or access to the payments accounts needs the sort of full bore federal or state supervision that banks have to face, because I just don't think that a payments company is doing something as risky as what a bank company is doing. So that's
Yeah.
why. Um, for that alone, that payment starter alone, I just see the costs and benefits as sort of different. And by the same token, if what you want to do is take deposits and custody them, then there ought to be a charter for you, which doesn't, require a bunch of people to look at your loan portfolio because you don't have one, or
Yeah.
whatever, So that's my view, is that different kinds of businesses pose different kind of risks, and full on banking regulation is appropriate for people engaged in that, or firms engaged in that sort of maturity mismatch.
So I'm guessing based on what you've just said that you'd be comfortable with any entity that wants to go into the payment space as long as they're not doing intermediation and creating credit, as long as they're strictly doing payments. And so we already have stable coins, at least in the Genius Act, is supposed to be doing that. And then there's issues to work out still with that legislation. But what about like other things? You mentioned PayPal, but what about, let's say Starbucks? They supposedly, I've read these stories, they have more money on debit cards than many banks do. I mean,
Yeah.
they're a payment provider effectively, or how about even Walmart? I mean, Walmart's applied, I believe, in the past for a bank charter. I mean, would you feel comfortable with these type of retailers as long as they were just doing payments and nothing else, no intermediation? Would you be comfortable with them participating?
I wouldn't have a problem if Walmart set up its own payment system, and you could imagine there being a demand for that kind of thing. And I think there I would part ways with, the community or the large banks, which I don't think would welcome that kind of competition. But no, competition can be a good thing. To me, what is surprising about Walmart is. I talk about this a little bit, but so in 2006 they want to get an industrial loan corporation charter. That's an obscure kind of charter, which meant that you could be a non-bank holding company and own a bank subsidiary and not have to register with the Federal Reserve and be regulated by it. So that's what an ILC does. And so the idea was Walmart was going to own a bank, an industrial loan company that would have the sort of powers of a bank, and that it would provide banking services for its clients. And it sought to get that, you got to get the state of Utah to sign off on your ILC charter, and then you have to get deposit insurance from the FDIC. And Walmart's application for deposit insurance was ultimately rejected, and the banking industry, I think, reacted to Walmart's proposal to get a banking charter with real concern, and a strong argument that this ends the separation of banking and commerce, and we want banking and commerce to be separate. We don't want banks to be doing commerce and commercial firms to be doing banking. And I've never really understood interest in that. There's a political economy story that, banks will get too big if they can do everything, including non-banking activities. I'm not so sure about what happened. But anyway, Walmart, right? So they gave up. Or did they? Right now, Walmart has money centers in half of its superstores. It's got a ton of debit cards that it issues to
Mm.
its customers that have given them access to the financial system. Walmart, in some ways, has done a lot to address the problem of debanking by offering Walmart debit cards, Walmart money centers, which it advertises one-stop shops, direct deposit of your payroll. Walmart can help you out there. It seems to me that, if you walk into a Walmart or, even a large grocery store in the suburbs, you'll often see a bank right there, or a money center.
Yeah.
So this separation of banking and commerce, which people have been worried about, I'm not sure that commercial firms have decided that they have got to stay out of the business of banking entirely, or if instead, in fact, commercial firms are getting into the business of banking in a bunch of surprising ways, very intentionally in the case of Walmart, and sort of less intentionally in the case of Starbucks or
Yeah.
airline frequent flyer miles. The idea is that these guys are storing tons of value of individuals like you, and stores of value of individuals like you and me with gift cards and awards miles, and
Yeah.
I don't want to turn this into a dorm room conversation at 4 a.m. or whatever, but I do think to
Right.
myself,
Right.
are we sure that banking hasn't been disintermediated by that kind of thing, in addition to, the risks of, Walmart actually opening up a bank?
Yeah, those are great points. And again, the key is we don't want Walmart or Starbucks to be making loans or doing the kind of taking on the risk, the credit risk that a bank would do. That is something distinct. But if they're just doing payments, it seems it would be something entirely different. And that's a great point. I hadn't thought of you brought up about grocery stores have effectively been doing banking for some time, right? You can cash a check there. I mean, what is my ATM in my real life? It's my grocery store. It's Walmart. Because I rarely do take cash out, but when I do, I'm shopping. I need maybe get some cash out to buy some Girl Scout cookies or something. I'll do it there, right? I don't go to a bank ATM. I can't remember the last time I've actually stopped by a bank ATM, and it's been some time.
Well, I started my career at the Department of Justice, so that was the sort of first time I was earning real money, or somewhat real money, and so I'm a member of the Justice Federal Credit Union, which doesn't even have an office in the state of Pennsylvania. So, I've been banking with them for a couple of decades, and I can't remember the last time I've set foot in a JFCU branch, but it probably has been a couple of decades.
Yeah, yeah. Well, one last thing on this, David, as we move forward. So there was a recent development, and this may not amount to much because it's two House members, but the House members are Representative Young Kim, a Republican from California, and Sam Liccardo, a Democrat from California, and they've proposed something called the PACE Act. So it's a bipartisan bill. That's the only reason I would bring this up, because there's many bills that are proposed that go nowhere. But
Mhm.
this one's called the PACE Act. And if I understand it correctly, it would change the law. It would make it easier for firms to become payment providers. It would give them access to the payment rails of the Fed, give them access to FedNow, FedACH, FedWire. It would set conditions and rules and regulations, and it would supposedly, complement the Genius Act and make it much easier to go on ramp, off ramp for, say, stable coins and such. And I know it's just been proposed, but just to put it on people's radar, what are your thoughts on it? Does it do anything more that's not already being done?
Um, yeah, I'm interested in the PACE Act, and basically, it looks like it's only eligible for payments providers who have at least 40 state money transmitter licenses. So what we're talking about are the big guys: PayPal, we've mentioned, Cash App,
Okay.
Apple Pay. Google Pay maybe. And what they would get is not quite a charter from OCC, but some sort of license from OCC that would enable them to use the Fed's payment rails. There's real restrictions on their, they have to custody the money. They can't lend out money that they're sort of holding for payments customers or whatever. So they can't act like a bank. They have to be a payments provider only. But they would get access to, uh, they would preempt state regulation. They would get an OCC license and they would get access to the Fed's payment rails. I was interested to see that it's bipartisan, and it looks to me like this does something somewhat similar to the master account access proposal that the Fed's doing, but would be congressionally blessed legislation. Um, and so less liable for less legal risk that you could do there. The Fed, OCC is acting in contravention of its chartering powers. It would get this explicit additional quasi chartering power and a congressional blessing that these payments processors ought to be able to use the Fed's payment rails. So in that sense, it offers something to payments providers that the Waller proposal doesn't. And we'll see. I did see it's bipartisan with a Democrat and a Republican. It's easy to introduce legislation in Congress. It's hard to pass it, but that's how I
Yeah.
see it doing differently.
Well, it'll be interesting to follow this along the payments development, Fed master accounts, stable coins, all this good stuff. We'll come back and revisit it sometime in the future. Now, I want to segue into another legal issue facing the Fed, and then that is how do we govern the Fed? How is the Fed accountable? Today, we are recording on April the 24th, and we just learned that the Department of Justice is dropping its case, its criminal proceedings against Jerome Powell. They are going to send it to the Inspector General at the Federal Reserve, who's not an independent IG.
Right.
It's actually, they report to the Fed chair. And so it effectively looks like they're killing us, so that Senator Tom Tillis will approve Kevin Warsh and we'll get a new Fed chair in. But this has been a part of a story that we've been following for some time. President Trump has been going after governors. Lisa Cook is going after Jerome Powell. And there's been some concern about all of this. Although I've always been a little less worried about this because the FOMC is a committee. It's not a one-person show.
Mhm.
It's a little harder to get things done on a committee. But there have always been questions about, well, who oversees the Fed? How should we think about them? I've had guests on the show, David, who've said, hey, we need to pull banking regulation out of the Fed because you know what? The OCC, the FDIC, they report more to Congress and, there's certain things they have to do that the Fed doesn't have to do. But you've made the case actually that the Federal Reserve, as well as some other financial agencies, are different than regular agencies. And let's go there because you have this Iowa Law Review article from 2023, "The Corporatist Foundations of Financial Regulation," and this really helps us think about how the Fed is different. So walk us through that.
I'd be happy to. So I'll give you sort of the negative case, the way that banking regulation is not like other kinds of regulation. And then the positive case is, so what is banking regulation? And my answer is it's corporatist. And that has a particularized meaning that maybe we can explore. But usually, a lot of people would say the way regulation works in the United States is through this, and I'm using the formulation of Bob Kagan at Berkeley, adversarial legalism. So when a government regulator wants to do something, they make a proposal, they receive comment on the proposal, then they promulgate the proposal, and then they're subject to suit in court under the Administrative Procedure Act. And by the way, if the regulator, if the president doesn't like what the regulator's doing, then the president can, remove some of the members of the regulator and put in people who he or she likes better. And if Congress doesn't like what the regulator's doing, then Congress can, limit appropriations, use the power of the purse to sort of bring the regulator into line, as well as passing other statutes. And that's not the only thing. I mean, I think that the OMB, OIRA, is another way in which the White House reviews regulators ordinarily, because any regulator that wants to pass a major rule has to get OMB, Office of Management and Budget approval to promulgate and then ultimately to issue that rule, to propose and then ultimately issue that rule. So congressional supervision, presidential supervision through a couple of channels, removal and OIRA review, OMB review, and judicial supervision through the Administrative Procedure Act. And what I think is interesting about the Fed and the other banking regulators is essentially none of those rules apply. The agencies are self-funded, so they don't need to get a congressional appropriation, and the OCC and the FDIC are funded with fees on banks that they examine, and the Fed is funded through seniorage mostly, but also there are fees for being a member of the Federal Reserve System and a holding company or whatever. So Congress doesn't really supervise these agencies. The president, in theory, though that's what the Cook and litigation is all about, the president can't remove independent regulators, or at least until the second Trump administration, presidents never removed regulators of independent agencies who had for-cause removal protections. And then banks, we talked a little earlier about how sometimes they're worried about reprisals. It's not clear whether that's the problem or if something else is the problem. But when I wrote that article, which was published in 2023, I was definitely right about this. Banks never sue their regulators. So you got this set of regulators out there who are not subject to any of the usual sort of guardrails that apply to the Environmental Protection Agency, the Securities and Exchange Commission, tons of other regulators who live in this world of we got to fight for our appropriation, we got to worry about what the president thinks of how we're doing in policymaking, we got to pass OIRA review, and we got to survive judicial review once our stuff is litigated. And banks don't have to worry about or bank regulators don't have to worry about any of that. So that is weird. That suggests to me that like the usual rules of adversarial legalism apply in some places, but weirdly don't apply in banking regulation. Okay, so that if that's the case, what do we have? And what I think we have is a sort of more corporatist kind of regulation. And corporatist regulation doesn't always get lots of praise by good governance types, though it's not necessarily a terrible way to do things. Corporatist regulation is the idea that we bring all the stakeholders in a regulated industry to the table, and we come up with an approach that works for everybody. So the classic example of corporatist regulation is German industrialization. In Germany, the government, the unions, and the firms all sort of come to some common understanding of what it is they want to do and how they want to do it, and that's the way that regulatory policy gets made, through sort of stakeholder negotiation rather than through adversarial legalism. And my suggestion is that that is not a terrible way of thinking about what's going on with the Fed and the other banking regulators. That they are responsive to industry and work closely with industry. The supervisors are on top of banks, inside banks often, the consumer facing or labor facing side is a little less obvious, but that this sort of relationship where it's sort of a stakeholder negotiated relationship is not totally uncommon even in the United States. I think you could look at defense contractors and say, well, that's sort of
Yeah.
corporatist. I mean, they sort of, they have one client and the government has one supplier, and, they have to work together. Or, utilities regulation. I know you've had on people who are interested in comparing banks and utilities, but that's certainly something that's out there in the legal scholarship, and they also have a sort of corporatist approach. You're not going to kneecap a utility and put it out of business. They can't throw all their ratepayers off, no water for you. You failed to pay your water bill last month. This sort of we're in it together sort of stakeholder relationship, I think, exists in some parts of the American economy. And I think that might be a good way of thinking about banking regulation as well.
That is so interesting. I remember a few years back, there was a term, I forget the name of the term, but Elizabeth Warren was promoting some version of stakeholder capitalism in the U.S. We needed to be more like the Germans.
Mm-hmm.
And I know there was pushback against it, but what you're telling me, well, some parts of the economy are already there. I mean, we're very German in our banking sector already.
Yeah, for better or worse. And I admit, I'm not sure exactly how to think about it, but it looks to me like
Yeah.
banking regulation is quite collaborative, as is defense procurement. I know that Elizabeth Warren statute was going to sort of create a federal charter for big firms, and
Yes. Yes.
everybody would have to go get a federal charter. And I'm pretty opposed to that idea, she talks a lot about crony capitalism, and I'm not going to
Yeah.
say there's no cronyism in any part of financial regulation. I think she's onto something there.
Yeah, I had a guest on some time ago, Sam Hammond, and we talked about this proposal for this federal charter, and he said the biggest challenge is that it's a cultural thing. Like you can't impose this from the top onto, say, a company like Apple or like Silicon Valley. It's very cutthroat capitalism. Steve Jobs comes in, he fires the entire board. That turnover, that kind of cutthroat, if ruthless efficiency would not work with the stakeholder capitalism model. But what you're saying is we already do have, in some industries like banking, which is very protected, slow moving, lethargic, maybe it does work because there's a different dynamism to it. So it's interesting to make that connection I hadn't thought of before.
No, I agree. There's something interesting about that, and I think you're absolutely right. For most businesses, we don't want like sort of safety and soundness style oversight for a Silicon Valley startup. Cut a deal, try to get financing, try to build a product, and if it works, it
Yeah.
works, and if it doesn't, then go out of business. That's a totally appropriate way to run large chunks of the economy. It promotes innovation and it keeps regulators off the case, and has firms looking more business judgment and business judgment protections, rather than to the courts and the regulators for what can I do, what is permitted and what is not permitted. And that's just not the way banking regulation works. There's lots of time where supervisors come in and tell the bank
Yeah.
to knock it off. And sometimes I've been interested in looking at these chartering activities. It makes sense, but one of the things that the federal charters want to know is what's your business plan and who is on your board of directors. And in that sense, they're sort of acting as consultants when they're assessing your initial application. They're saying, so is this bank going to make money? And if the answer is yes, then we'll charter it. And if we're not sure the answer is yes, then maybe we won't. Um, and trying to figure out an answer to that question, they're often providing advice. Have you diversified your loan portfolio enough? Are you going to be too exposed to agricultural banking if you set up in this part of the country? It's just a different kind of relationship than the relationship that you'd expect from, somebody who's trying to figure out if you're polluting too much or not.
So let's take this thinking, this corporatist model or view of what's happening in banking industry, and let's apply it to the Supreme Court case. I believe last year it was for the National Labor Relations Board and some other agency where Trump fired a bunch of head people, the regulators, and then in a footnote they said, well, the Federal Reserve is exempt from this. Because they're special, and they cited the Second Bank of the United States. And now all of you legal scholars were like rolling your eyes. This is terrible reasoning. This is not the way to motivate it. But it sounds like what you outline, this corporatist model, might be a better way to motivate this. Look, they're just a different model altogether than some of these other agencies that maybe regulate, like the Environmental Protection Agency, for example. Would that be one way to get better reasoning for the decision they made there?
That might well be, and I'd love it if I could get the
If they
Supreme
cited you,
Court.
yes.
Now we're talking. But the Yes, I mean, I think that one of the questions with regard to these regulators who have been removed by President Trump, there's been this weird aspect of independent agencies, which is that in some cases, and this is the case in financial regulation, you could have a situation if you can't remove a regulator for any reason or no reason at all. If the regulator has for cause removal protection, then you get this weird situation, which we had briefly during the Biden administration, where the person running the Consumer Financial Protection Bureau is from the other party as the president, or the vice chair of supervision. There was a possibility before, I think, Vice Chair Barr resigned his vice chairmanship and remained as a governor on the board, but left the vice chair for supervision office open for Michelle Bowman to the president wouldn't have appointed the person carrying out his bank policy and supervision and examination priorities, or his consumer protection priorities. Kathy Kraninger is the head of the CFPB during the first year of the Biden administration, even though President Trump appointed her. But she's a single head for a term of 5 years, and a 5-year term hadn't run out, and so. Biden was stuck with her, or was stuck with her until the Supreme Court said you can't have a single head who's got for cause removal protection, and so therefore what the CFPB has done is would be unconstitutional unless the president can remove the head of the CFPB for any reason. And the day that decision came down, that was the day that Biden removed Kraninger from the CFPB. I guess what I'm saying is you get this weird situation with removal protection and financial regulation, most of instances where the president is, elected to carry out a bunch of policy responsibilities and then can't do or can't require his subordinates to carry out the policy priorities that he wants to. But maybe a corporatist system, maybe the need to have presidential control or supervision is less, prominent. Maybe as long as all the stakeholders sort of agree on what banking regulation ought to look like, maybe that's a reason to preserve the independence of say, the Fed. I think I'm not too persuaded by the sort of originalist argument, but I think that's not the way. I think Lisa Cook is likely to win her case, and she's likely to win her case because of the existence of the first and second Bank of the United States. And a couple of my colleagues, law professors at Cornell and Virginia, wrote an article sort of making the case here. We've had independent banks chartered by Congress. So we had it at the founding, and so therefore maybe the Federal Reserve is like that. Now, there's a bunch of ways in which it's not like the first or second Reserve Bank of the United States. But I'm betting that the court will conclude close enough. The Bank of France and the Bank of England, they weren't privatized until the 20th century. So they were private banks, just like the first and second Bank of the United States. And nobody says, oh, well, they're not central banks. They are central banks. They're the Central Bank of England, the Central Bank of the United States. And so maybe the Fed could have some private banking and antecedents before it was set up that suggests that it should be treated differently than the Environmental Protection Agency, which didn't have any sort of private antecedent before Congress created it in 1970.
One last question on this corporatist model. So it applies to all the federal bank regulators, not just the Fed. But the Fed is the one that gets singled out as the independent agency. It's the one that gets the footnote in that Supreme Court decision.
Yep.
So should that same deferral be applied to the OCC and the FDIC that's being applied to the Fed? I mean, if they are all corporatist models, should these agencies be more independent on the same level as the Fed?
Yeah, the corporatist account might suggest that they should get the similar kind of independence that, Congress doesn't have to go down this route. This isn't required by the Constitution or anything. But if Congress is happy with the corporatist model of financial regulation, maybe that's a reason to keep financial regulators, independent and with less of an ability of the president to remove them. I confess that I'm actually more persuaded, by your other guests who have said, well, maybe we ought to strip supervision and examination out of these agencies and make them, or strip independence, supervision and regulation out of the Fed, and make the Fed, the OCC, and the FDIC they'll make those officials removable by the president for their supervisory stuff. But when it comes to monetary policy, and the Bank of the United
Yeah.
States did help with monetary policy, there you really do want decision makers who aren't politicians, who aren't likely to, inflate to chase growth in the short term at some cost to the long term, expectations of investors and managers and businesses. Um, uh, and so I think there's maybe something to that, that when banks are being supervised and regulated, they're subject to presidential policymaking and they should be subject to electoral oversight. But for monetary policy, there's a good reason not to do that. I will say that if there's a good reason not to do it in monetary policy that's not based on original, what were the founders thinking about, then there may be good reasons to have independent agencies in a bunch of different places. But there's, at the very least, had good reason to consider the independence of the Fed.
So just to be clear, you're saying in your article, you're more observing that there is this corporatist model. You're not necessarily endorsing it in some of these applications.
Yeah, I mean, well, I think, David, your earlier analogy was spot on. They don't have a Silicon Valley in Germany, and indeed, there's a lot of Germans in Silicon Valley, and the reason they went there is because they think there can't be a Silicon Valley in Germany, and so
Yeah.
they want their risk-taking ethos and the network effect
Yeah.
that you get from doing stuff in the United States, where there's not sort of heavy corporatist oversight. I'm inclined to agree with that. But if what you think is that banking is super dangerous, and yet we've arrived at a world where Congress and the president and the courts aren't really checking what the Fed's doing, then maybe it's good enough if industry buy-in is sufficient to, along with the Fed's own regulatory priorities and concern that it could be blamed for a financial crisis. So it has a reason for its own high standards. Maybe that's cold comfort, but a second best that we can all live with when it comes to legitimacy and accountability and stuff like that.
Well, on that note, our time is up. Our guest today has been David Zaring. David, thank you so much for coming on the podcast.
It's a pleasure. Thanks so much for having me.